Welcome back to the Money Pros. Today's show is all about interest rates and what consumers need to know as they navigate the worlds of borrowing and lending. I'm joined once again by Steve Tetzner, Vice President with Homestar Mortgage, and Russ Towers, Vice President with Broker Service Marketing Group. We're also joined now by our investment money pro, Rob Auclair, Financial Advisor with Radel Financial Group. Gentlemen, welcome to our roundtable without the roundtable. I'm happy to have you all here. I'm going to start off by putting up a slide, which I found pretty surprising as I was doing some research for the show. This is a graph. I know it's not super visible, but it actually shows the yield on the 10-year Treasury going all the way from 1965 to current 2011. That giant peak, Mount Everest in the middle, is actually 1982 when interest rates skyrocketed. But you can see from that point in time, 1982 going forward to today, rates are as low as they've ever been on the 10-year Treasury. And as we've talked about earlier in the show, it's the 10-year Treasury driving a lot of what we talk about with consumers and interest rates. Rob, I want to turn to you with the first question and try to get just some kind of understanding of, particularly in, say, the last 3 years. I won't ask you to give us a history back to 1982, but say in the last 3 years, what is it that's continually pushing market interest rates lower? It's being driven off of the 10-year Treasury. But what's driving the Treasury level? What's going on?
I mean, there's a lot of things, but I think one of the major and the biggest things would be the Federal Reserve's actions that they're taking. And two of the major actions that they have been taking continuously for the last 2 or 3 years would be lowering their interest rates, which trickles down to what they lend to banks, which trickles down to ultimately the consumer. So the rates just keep going down. The other thing that they have done is they've gone into the open market, purchased treasuries, therefore raising the price of the bonds. And what ends up happening with that is the inverse relation, interest rates get driven down. So those two things the Federal Reserve has done have, continued to lower the rates. Another thing is the worldwide economy. And if we look at Europe for a second and Greece and a lot of the problems that they've had there, in Europe they are in a sense looking for the safest place because there are so many unsafe places there. So what they're doing is they're fleeing that, and the money is just rushing into U.S. Treasuries because it still ends up being one of the safest investments in the world.
And again, driving the price up, right?
Correct.
Then the yield's going down.
Correct. Yeah.
So one of the interesting things, I think, a lot of people thought that with the downgrade by Standard & Poor's of the U.S. Government debt from AAA to AA, which obviously got a lot of headlines, that was going to drive interest rates up. And in fact, it doesn't seem like at this point we've seen that. Russ, I want to turn to you really quickly and ask, have you seen much impact, at least in the insurance, the annuity arena, with carriers who are greatly affected by interest rates? Did that credit downgrade affect their business or your business in any way?
We really haven't seen an effect because the United States U.S. government securities still seem to be the safest place in the world for people all over the world to place their money. And so the annuity business, especially the fixed guaranteed annuity business, has actually boomed over the last 2 or 3 years because of the flight to safety, if you will. And what's the flight to safety? Well, not only the guarantee, but also what are the underlying investments that insurance carriers are placing those funds into are largely U.S. government securities, which still seem to be the safest place in the world.
So in some sense, no matter what S&P says about the U.S. being a less better bet maybe than it was a few months ago, if everybody still thinks it's the safest game in town, it doesn't really change the interest rate environment.
That's exactly right. And you have to remember that Moody's did not downgrade U.S. government securities. It was only Standard & Poor's.
Sure.
And so out there in the world, there's still this concept, an idea that, the United States, despite the problems we have with the deficit and the debt, nevertheless, there's a feeling that we will get our house in order. And the safe place to place investment securities is in the United States. That's right.
Steve, let me turn to you and on a little bit different front, but of course related to interest rates, which is our topic today. Many of our viewers, probably most of them, have had the experience of borrowing for a mortgage. The stack of paperwork is intense. There's a lot going on in there, and a lot of it talks about interest rates, things about APR, APY, rate locks, the amount of interest you'll pay over the life of the loan. I'm curious, generally how knowledgeable do you find consumers with topics related to interest rates? Do they understand compounding? Do they understand the concept of yield? Do they understand things like when is a good time, is it time for me to refinance? I'm at 5%, rates are now at 4.25. Should I go for it or should I hang? How much do they understand about that stuff in general?
I think a lot less than they probably should. A lot of people don't understand the amortization of a loan. They don't understand the effects of shortening the term of a loan, where a lot of people look at their refinance situation and maybe they're 2 years into their 30-year mortgage and they refinance and they go back to a 30-year mortgage again, and they're saying, well, I'm saving $200 a month. They're really not saving $200 a month if you look at the amortization comparison of the old loan, what they were paying per month, what portion was going towards principal and what portion was going towards interest. Whenever I refinance someone, I always encourage them, if their cash flow can support it, to shorten the term of the new loan. So if they were in a 30-year and they're a year or two in, look at a 25 or a 20. Always look at shortening the loan. That's how you save interest over the life of the loan on any type of mortgage.
On the back end, that's where the tens and thousands of dollars of savings is going to be. It's not about saving the $100 a month on your mortgage payment.
Not at all. And very often, you know, sometimes people look at that, and if you add another 2 years to the end of your loan, if the person actually kept the loan for 30 years, the savings was negligible.
Okay. Rob, let me turn back to you, because one of the other important factors with interest rates is what impact it's going to have on people's portfolios. People are invested in stocks, bonds, mutual funds that own stocks and bonds. With interest rates where they are, they've been going down steadily for the past 3 years. In fact, they've been going down steadily since 1982, as we saw from the chart.
Right.
What are some of the things that people should be paying attention to in their portfolio with regard to how interest rates impact it?
First thing they need to understand is the inverse relationship between bond prices and interest rates, and just knowing when bond prices are going up, interest rates are going down, and vice versa. And so what we've had over the last 2 or 3 years is obviously a steady decline in interest rates. Therefore,
bond prices are doing well.
Bond prices are going up, and that portion of their portfolio is doing very well. So they need to pay attention, and it doesn't mean bond prices are automatically going to go up from where they are now. They certainly could go down more, but what you want to do is get some protection on that. And the ways in which to do that is to really shorten the duration of the bonds that you have. So maybe something under 5 years or 3 to 5 years rather than going longer term out.
So you want to look at your maturities, because I know that with our client portfolios, we're looking at short and intermediate, and we're staying away from the long-term maturities, given where interest rates are right now.
Yeah.
Super valuable information. All right, I'm going to have to wrap up our conversation here, but I want to thank you all for participating. When we come back, our mortgage pro Steve Tetzner is going to answer some a viewer question on reverse mortgages. You don't want to miss this, so please stay tuned. We'll be right back right here on the Money Pros.